Hi, in this video we will be talking about the art of borrowing. Watch this video to the end to learn guide to wise financial decisions. Welcome back to the International CEO. In today's world, borrowing money has become an integral part of managing personal and business finances. Whether it's for purchasing a home, funding education, or starting a business, borrowing wisely can pave the way for financial success. However, it's essential to understand the intricacies of borrowing and to make informed decisions to avoid falling into debt traps. In this guide, we'll delve into the principles of borrowing money wisely and how it can contribute to long-term financial well-being. Understanding your financial situation. Before considering borrowing money, it's crucial to assess your current financial situation. Take stock of your income, expenses, assets, and liabilities. Understanding your financial standing will help you determine how much you can afford to borrow and repay comfortably. Create a budget to track your expenses and identify areas where you can cut back to save money. Setting clear financial goals. Having clear financial goals is paramount when it comes to borrowing money. Whether it's buying a house, paying off debt, or investing in education, define your objectives and prioritize them. Consider the timeline for achieving each goal and how borrowing fits into your overall financial plan. Aligning your borrowing decisions with your goals will ensure that you borrow with purpose and avoid unnecessary debt. Exploring borrowing options. There are various borrowing options available, each with its terms, conditions, and interest rates. Before borrowing, research and compare different lenders, including banks, credit unions, online lenders, and peer-to-peer lending platforms. Evaluate factors such as interest rates, fees, repayment terms, and customer reviews to choose the most suitable option for your needs. Interest rates play a significant role in borrowing money, affecting the total cost of borrowing over time. It's essential to understand the difference between fixed and variable interest rates and how they can impact your monthly payments. Additionally, be aware of any associated fees, such as origination fees, late payment fees, or prepayment penalties. Factor these costs into your borrowing decision and choose a loan with transparent terms and minimal fees. Assessing your creditworthiness. Lenders evaluate your creditworthiness to determine your eligibility for a loan and the interest rate you'll be offered. Your credit score, income, employment history, and debt-to-income ratio are some of the factors considered in the credit assessment process. Before applying for a loan, review your credit report for errors and take steps to improve your credit score if necessary. Paying bills on time, reducing outstanding debt, and maintaining a low credit utilization ratio can help boost your creditworthiness and qualify you for better loan terms. Calculating affordability. When borrowing money, it's crucial to assess whether you can afford the monthly payments comfortably. Use online loan calculators to estimate your monthly payments based on the loan amount, interest rate, and repayment term. Compare these payments to your monthly income and expenses to ensure that you can manage them without stretching your budget too thin. Avoid borrowing more than you need or taking on monthly payments that exceed a reasonable portion of your income. Choosing the right type of loan. There are various types of loans available, each designed for specific purposes and borrower profiles. Common types of loans include mortgages, auto loans, personal loans, student loans, and business loans. Research the features and requirements of each loan type to determine which aligns best with your borrowing needs. For example, if you're buying a home, a mortgage loan may offer lower interest rates and longer repayment terms than a personal loan. Choose the type of loan that offers the most favorable terms for your situation. Reading and understanding the fine print. Before signing any loan agreement, carefully read and understand the terms and conditions outlined by the lender. Pay attention to details such as the interest rate, repayment schedule, fees, penalties for late payments or early repayment, and any clauses that may impact your loan terms. If you have any questions or concerns, don't hesitate to ask the lender for clarification. Avoid signing any document until you're fully comfortable with the terms and confident in your ability to fulfill them. Creating a repayment strategy. Once you've borrowed money, it's essential to have a repayment strategy in place to ensure timely repayment and avoid defaulting on the loan. Consider setting up automatic payments or reminders to help you stay on track with your monthly payments. If you encounter financial difficulties, communicate with your lender proactively to explore options such as loan modification, deferment, or forbearance. Prioritize loan repayment to minimize interest costs and improve your creditworthiness over time. Monitoring your borrowing behavior. Borrowing money isn't a one-time decision but rather a continuous process that requires monitoring and adjustment over time. Periodically review your borrowing behavior, including your outstanding debt, credit utilization, and credit score. Identify opportunities to refinance existing loans at lower interest rates or consolidate multiple debts into a single loan for simplified repayment. Stay vigilant about your financial health and make adjustments as needed to stay on track towards achieving your goals. Borrowing money can be a powerful tool for achieving financial goals and milestones, but it must be approached with caution and prudence. By understanding your financial situation, setting clear goals, exploring borrowing options, and making informed decisions, you can borrow money wisely and pave the way for long-term financial success. Remember to borrow only what you need, choose loans with favorable terms, and prioritize timely repayment to build a strong financial foundation for the future. With careful planning and responsible borrowing, you can leverage the benefits of borrowing money while avoiding the pitfalls of excessive debt. Managing debt responsibly. Debt management is a crucial aspect of borrowing money wisely. While some level of debt may be necessary to achieve financial goals, it's essential to keep it manageable and avoid excessive debt burdens. Here are some strategies for managing debt responsibly. Prioritize high-interest debt. If you have multiple debts, prioritize paying off those with the highest interest rates first. By tackling high-interest debt aggressively, you can save money on interest payments and become debt-free sooner. Consider debt consolidation. Debt consolidation involves combining multiple debts into a single loan with a lower interest rate. This can simplify repayment and potentially reduce your monthly payments, making it easier to manage your debt load. Avoid using debt to finance lifestyle expenses. While it may be tempting to use credit cards or personal loans to fund discretionary purchases, such as vacations or luxury items, it's essential to avoid accumulating debt for non-essential expenses. Instead, focus on building savings and using cash for discretionary spending. Communicate with creditors. If you're struggling to make payments on existing debt, don't ignore the problem. Reach out to your creditors to discuss hardship options such as repayment plans, deferment, or forbearance. Many creditors are willing to work with borrowers facing financial difficulties to find a solution. Monitor your debt-to-income ratio. Your debt-to-income ratio is a measure of your total monthly debt payments relative to your monthly income. Aim to keep this ratio below 36% to ensure that you're not overextended financially. Leveraging assets for borrowing. In addition to traditional borrowing options, such as loans and lines of credit, you can also leverage assets to access funds when needed. Here are some ways to use assets for borrowing wisely. Home equity loans and lines of credit. If you own a home with equity built up, you may qualify for a home equity loan or line of credit. These loans allow you to borrow against the value of your home, using the equity as collateral. Home equity loans often have lower interest rates than other types of borrowing, making them an attractive option for large expenses such as home renovations or debt consolidation. Retirement account loans. Some retirement accounts, such as 401k plans, allow you to borrow against your account balance. While borrowing from your retirement savings should be approached with caution, it can be a useful option for addressing short-term financial needs without incurring taxes or penalties. However, be aware that failing to repay the loan according to the terms can result in taxes and penalties, as well as jeopardize your retirement savings. Cash value life insurance loans. If you have a permanent life insurance policy with cash value, you may be able to borrow against the cash value of the policy. These loans typically have low interest rates and flexible repayment terms, making them a convenient option for borrowing money while preserving the death benefit of the policy. However, keep in mind that borrowing against your life insurance policy can reduce the death benefit and may have tax implications. Navigating financial emergencies. Financial emergencies can arise unexpectedly, requiring access to funds on short notice. Here are some strategies for navigating financial emergencies wisely. Build an emergency fund. One of the best ways to prepare for financial emergencies is to build an emergency fund. Aim to save 3 to 6 months' worth of living expenses in a readily accessible savings account. Having an emergency fund can provide a financial safety net, allowing you to cover unexpected expenses without resorting to high-interest borrowing or tapping into retirement savings. Explore alternative financing options. In addition to traditional borrowing options, such as loans and lines of credit, consider alternative financing options for short-term needs. For example, you may be able to negotiate payment plans with service providers or take advantage of community resources for financial assistance. Evaluate insurance coverage. Review your insurance policies, including health, auto, and homeowners, renters insurance, to ensure that you have adequate coverage in place to protect against unexpected events. Having the right insurance coverage can help mitigate financial losses resulting from accidents, illnesses, or property damage. Avoid using high-interest credit. In times of financial distress, it may be tempting to turn to high-interest credit cards or payday loans to cover expenses. However, these types of borrowing can quickly lead to a cycle of debt with high interest charges and fees. Explore lower-cost borrowing options or seek assistance from nonprofit credit counseling services if you're struggling to make ends meet. Seek financial assistance. If you're facing a financial emergency and don't have the resources to cover expenses, don't hesitate to seek financial assistance from family, friends, or community organizations. Swallowing pride and reaching out for help can provide temporary relief and support as you navigate through challenging times. Borrowing money wisely requires careful planning, prudent decision-making, and responsible financial management. By understanding your financial situation, setting clear goals, exploring borrowing options, and navigating financial emergencies, you can make informed decisions that contribute to long-term financial success. Remember to borrow only what you need, choose loans with favorable terms, and prioritize timely repayment to build a strong financial foundation for the future. With diligence and foresight, you can leverage the benefits of borrowing while avoiding the pitfalls of excessive debt, paving the way for a brighter financial future. Advanced strategies for optimizing borrowing decisions. Strategic use of credit cards. Credit cards can be powerful financial tools when used wisely. Take advantage of rewards programs, cashback offers, and introductory 0% APR periods to maximize the benefits of your credit cards. However, be sure to pay off your balance in full each month to avoid interest charges and minimize the impact on your credit score. Tax-deductible borrowing. In certain situations, interest paid on loans may be tax-deductible, providing an opportunity to lower your overall tax liability. For example, mortgage interest on a primary residence and student loan interest may be deductible, subject to certain limitations. Consult with a tax professional to understand how you can leverage tax-deductible borrowing to your advantage. Leveraging good debt for wealth building. Not all debt is created equal, and some types of debt can be considered good debt when used to finance assets that appreciate in value or generate income. For example, taking out a mortgage to purchase a home or borrowing to invest in a business or education can potentially yield long-term financial benefits. Evaluate the potential return on investment when considering borrowing for wealth-building purposes. Utilizing balance transfer offers. If you have high-interest credit card debt, consider transferring balances to a card with a lower promotional interest rate. Many credit card issuers offer introductory balance transfer offers with low or 0% APR for a limited time, allowing you to save money on interest and pay down debt more quickly. Be mindful of balance transfer fees and the duration of the promotional period. Maintaining financial stability. Regular financial checkups. Schedule regular financial checkups to review your financial goals, assess your progress, and make any necessary adjustments to your borrowing and saving strategies. Monitor changes in interest rates, evaluate your debt-to-income ratio, and track your credit score to ensure that you're on track to achieving your financial objectives. Continual learning and education. Stay informed about personal finance topics and trends by reading books, attending seminars, and following reputable financial websites and blogs. Continual learning and education can empower you to make informed financial decisions, adapt to changing economic conditions, and take advantage of new opportunities for wealth creation and preservation. Emergency preparedness. In addition to building an emergency fund, consider other aspects of emergency preparedness, such as having adequate insurance coverage, creating a will and estate plan, and establishing a power of attorney. Being prepared for unexpected events can provide peace of mind and protect your financial well-being in times of crisis. Diversification and risk management. Diversify your investments across different asset classes, industries, and geographic regions to reduce the risk of loss and enhance long-term returns. Regularly review and rebalance your investment portfolio to ensure that it remains aligned with your financial goals, risk tolerance, and time horizon. Borrowing money wisely is a multifaceted endeavor that requires careful consideration, strategic planning, and ongoing monitoring. By implementing advanced borrowing strategies, maintaining financial stability, and staying committed to long-term financial goals, you can navigate the complexities of borrowing with confidence and achieve sustainable financial success. Remember to stay informed, be proactive, and seek professional guidance when needed to make the most of your borrowing decisions and build a solid foundation for a prosperous future. Thanks for watching. If you found this video helpful, please give it a thumbs up, hit that bell, comment, and subscribe for more content on the International CEO. See you next time.